먼저 얼라이언스번스틴 주식부문 선임 투자전략가 데이비드 왕님께서 미국 증시 전망을 주제로 발표해 주시겠습니다.
Greetings. My name is David Wong, and I'm the Senior Investment Strategist for Equities at AllianceBernstein. It's my pleasure today to speak to you about the U.S. equity market and its prospects ahead of the upcoming U.S. presidential and congressional elections on November 3rd. First of all, I think we have to ask ourselves a basic question. Does it make sense to invest based on political outcomes anyway? If we look at the performance of the S&P 500 index over the last 55 years from 1965 until last year, during terms that had a Democratic president, the S&P was up 9.2%. During terms where there was a Republican president, the S&P was up 9.1%. In other words, it was exactly the same outcome, which does recommend that investors should not pay attention to politics and simply stay invested. If we look at how one would have done if you had invested $10,000 in 1937, but then taken it out anytime there was a Democrat in the White House, what we'd find is that the outcomes, either if one only invested during Republican presidencies or during Democratic presidencies, was far worse than simply staying fully invested at all times. And I think it is fair to say for the bulk of your asset allocation, one should stay fully invested and to ignore the political noise that may influence thinking about equity markets one way or another. That's at least true in the United States. Now, when we look at the actual result of the presidential election, what we find is that it's actually rare to have a one-term president. There are only 4 cases of incumbent US presidents to have lost re-election since the Great Depression. But what they all have in common, as you can see on this chart, is that the unemployment rate in the United States was certainly above average during the final year of that presidency. And when we look at the unemployment today, under Donald Trump, although it may be largely no fault of his own because of COVID-19, that unemployment rate of 7.9% bodes quite poorly compared to the unemployment rate which was at a similar level when other presidents from Gerald Ford to Jimmy Carter and George H.W. Bush lost the White House after their first term in office. Incidentally, what we find for these more recent presidents is that U.S. equities in all cases had delivered positive returns during their term in office. Now, we do think that COVID is going to have a significant bearing on this current election. When we compare polling data nationally as well as in the battleground states, these numbers almost universally look worse today as of October 8th when we compare these numbers to the data on March 1st, just before we experienced significant lockdowns in the United States and frankly around the world. And what we find is that whether it's the national polling where candidate Biden is actually ahead by almost 10% to a lot of the major swing states such as Arizona, Florida, North Carolina, Wisconsin, Pennsylvania, or Michigan, the differential is meaningfully higher in most cases today than it was at the beginning of this year. And generally speaking, when that net approval rating is quite poor, those are those times when the incumbent president is quite vulnerable. Now, it's really, as I alluded to earlier, the performance of the president in the swing states, in the battleground states, that really makes a big difference. We all know that Hillary Clinton actually won the popular vote in 2016, but did not win the state-oriented electoral college vote in some of the key swing states. And although she did take New Hampshire, Minnesota, and Nevada by small pluralities, what we find is that in these key swing states such as Michigan, Pennsylvania, Wisconsin, and Florida, although Trump won these by very small pluralities of the vote, those wins were really decisive in changing the outcome of the presidential election. Now, in terms of outcomes, bearing in mind the caveat that we provided earlier that we do not recommend investing based on election outcomes, we do think that in the short term, there may be a positive result for the markets if we get both a congressional and a White House win for either party. And the reasoning behind that thinking is that it's very clear to both the Republicans and to Democrats that stimulus and fiscal spending is absolutely necessary to push the economy on an upward track and to really facilitate the recovery that is already underway. However, what we also know is that the US frequently experiences divided government. And what we generally find with divided government is that it is hard to reach some sort of an agreement on how that money should be spent. And so that is why we would imagine if the Democrats take the White House but do not actually achieve a majority in the Senate, as well as the House of Representatives, which they already control, then we would expect for there to be a much more difficult environment for that President-elect Biden in that scenario to really push forward his legislative agenda. And without significant fiscal stimulus, Republicans in the Senate would probably rediscover their taste for austerity, and they would actually hold back funding for fiscal stimulus. And that's really why under a Democratic White House and a Democratic Senate, which now at this point, based on recent polls, looks increasingly likely at about 60 or 65% chance, there is a significant likelihood of substantial fiscal support. And we do think that while there is also the prospect of things like more regulation and higher taxes, some of these fiscal stimulus programs could offset some of the negative sentiment around higher corporate taxes for US companies. Now let's talk about the equity market outlook overall. This has been a really extraordinary year in 2020. And what has really determined the path of performance for any asset class is central banks and the monetary support that we've seen around the world, and whether or not a given asset was subject to cyclicality and to sensitivity to the macroeconomy. That's what drove asset prices in 2020. And that's why when we look at US growth equities, which is largely clustered in sectors like technology, like healthcare, like e-commerce and other types of consumer-oriented or media-oriented businesses, these businesses were not really affected by the pandemic. And that's why, as of October 7th, they were up 26% on the year. Other assets like gold did well because people feared that there would be financial repression due to record low interest rates. And the 30-year Treasury simply did very well as interest rates came down. U.S. equities as an overall asset class, and we're talking here of the S&P, did well also and has done better than most other major equity markets. And this is because although some parts of the U.S. equity market felt the pain of this pandemic and felt the losses experienced also by the economy, the reality is that much of the U.S. equity market, as we'll soon see, is not that economically sensitive. And what we see here on this chart is that the more economically sensitive a given asset class was, the more pain that investors felt by holding that asset class. And so high yield was generally flat on the year, emerging market equities slightly down, Japanese equities a little bit worse than that, European equities, which has a lot of bank exposure, did quite poorly. And the worst of all was CCC rated, the lowest rated of high yield bonds, which really did not benefit from any central bank support. When we look at page 9, this is a somewhat complex table, but the real takeaway is that there are some parts of the U.S. equity market, even in the worst quarter, which was the second quarter, that saw positive year-over-year earnings growth. And it's really the fact that 77% of the U.S. equity market actually felt no earnings drag at all, or only a modest impact to earnings, that we find that the year-to-date return for these types of sectors, such as especially healthcare, technology, and staples companies, did rather well this year. And it's really in this bottom third of the U.S. market, or bottom quarter, which is concentrated in financials, industrials, materials, and energy, that did particularly poorly. And we would actually make the point that if you wanted to bet on an economic recovery, these are often the sectors that will pick up the most in the short term. But we would also point out that there is a value in a time of uncertainty and lower growth where having some visibility over future earnings is actually very good for investors. And that's really also why when we look at the disparity between earnings decline experienced by some of these worst hit sectors and their performance this year, we actually think that there's more recovery priced into these cyclical sectors than there are in these secular growth sectors, especially, for instance, healthcare. There is actually still quite a lot to worry about as we approach 2021. There are second, third, even fourth waves of COVID-19 infections that are being felt around the world that may get worse as we enter into wintertime. We also find that there is a US-China Cold War that may not necessarily improve under a Biden presidency. Equity market valuations, while justified by interest rates, are high versus history. And of course, the elephant in the room is how the US elections will shape policy for the US and the world in years to come. Now, one reason why we continue to like the US equity market is that along with China, the US and China, which are locked in a Cold War of sorts, are ironically also the best insulated from the fallout from a decline or stagnation in international trade. And that is because companies in these two markets have much higher domestic revenues exposure than companies in the rest of the world. And it's really that lack of dependence on overseas revenues that can actually be quite helpful during times like these, especially when we have seen a rise in populism and domestic sourcing around the world. On this point of valuations, we do find that the S&P 500 is priced at a level on a PE basis that is well above the long-term average. But we always have to reference valuations to something. And in the case of the US equity market, we would say that the most obvious benchmark for valuations is actually the risk-free rate or the 10-year Treasury bond. And what we find is that the 10-year Treasury is far more expensive today than its 20-year average, whereas the amount that valuations are elevated for the US equity market are modest by comparison. And as long as one believes that interest rates will remain low for years to come, the risk of a significant valuation decline is actually relatively limited in our view. What is of greater concern, though, is what has worked this year. If you look at the S&P 500, the top 5 companies in terms of performance and size were all technology related. And if we actually excluded these top 5 companies from the S&P overall this year, it would have only provided a break-even performance or even slightly negative performance. And when we look at the concentration of these 5 largest companies as a share of the total of the S&P, it is at the highest level ever. And so while we think that there is not immediate risk of a valuation compression for these top tech companies, it does mean that there is a lot of idiosyncratic risk and vulnerability to continued execution by these companies on a bottom-up basis. Because after all, if they were to miss on earnings and disappoint investors, that would not only likely hurt from having lower earnings, but the multiple would probably decline as well. However, it's important to remember that the market tends to be short-term in how it actually evaluates companies. And what we find is that the market generally does not expect companies that can deliver growth consistently to be able to maintain that growth over time. And we've illustrated that in this study that we've done at AB. What we looked at was for all of the companies in the US market, we have found that for the top 1,000 in any given year, 377 of them could deliver earnings growth that was 10% or more. And in that year, the relative alpha or premium performance over the S&P market of those companies was 1%. But when we look at this over 3 years, what we find is that the number that can do this 3 years in a row actually is only 64 out of 1,000. But those companies that could persistently and consistently deliver earnings growth of 10% or more got an annual premium over the S&P of 2.2%. And if we find this same number over, say, a 5-year period, this tends to actually grant the companies that can deliver this, and there's very few, an extremely attractive annualized premium over the S&P of 3.5% per annum. So what that tells us is that growth is difficult to maintain, but if you can pick those companies that can deliver that growth, you're much better owning those companies year in, year out, and staying invested rather than trying to trade and find some new growth company every year. And it also tells us that not everything that has a high PE, that is highly valued, is in fact expensive. Because if they actually do deliver on that earnings growth for several years to come, they will grow into their valuation. What this means is that we need, as active managers of growth equities in the US, which is where we think one should be placing capital today, into businesses that benefit from trends that have been accelerated by our traumatic COVID-19 experience in 2020. We think that there are companies that will benefit from new behaviors such as flexible work, e-commerce, and online payments, and also the desire to avoid crowds. And there are certain companies that will be market share gainers, whether it's in retail in particular, but also in a variety of different fragmented industries. And we want to also avoid the losers at the same time. Remember that even when economic growth is weak, investing in equities, especially in the US, where the US equity market is not that macro sensitive, it has very little to do with GDP. And that is because we can find growth trends that persist even through downturns. These are from factors as varied as wind capacity, digital payments, DNA sequencing, or internet traffic. All of these factors will keep growing regardless of whether or not there is a pandemic on. Now, what we would say, though, is that if you want to be a little bit more defensive in one's positioning, one should avoid those concentrated technology positions, not avoid them altogether, but perhaps underweight them and to have a little bit more weight to some of the more defensive sectors that are actually trading at relatively cheap levels versus history. When we look at sectors like healthcare or consumer staples, we find businesses that are actually trading at some of the cheapest levels relative to the broader market. They're not cheap in absolute terms versus history, but versus where technology or consumer discretionary businesses may be, we can find some value. And we do think that healthcare in particular is an attractive place to be allocating today. However, healthcare investing has its own risks as well. And although there is a lot of growth potential from healthcare, because it is where innovation meets demographics that are very much in our favor, the demographic demands of the developed world also mean that there is increased scrutiny on pricing. And what individuals pay, the company pricing structure, and the margins of businesses require very careful scrutiny if you're investing in the healthcare sector. And this is where we need to do scenario analysis and understand what happens, for instance, in the case of a Biden victory and a blue wave sweeping Congress. And while we do think, for instance, that there will be some impact on drug pricing, we would also expect that drugs that are developed that completely improve the outcome for a patient compared to the past standard of care will still be paid for in any environment. And so when we look at the key market risks of a Biden blue wave, we do think that all companies will be subject to higher taxes. But we do not think necessarily that this is going to happen in 2021. We think the first priorities will be additional fiscal stimulus first, and that the tax hike, if it happens, may happen perhaps in 2022. We do think that under such a scenario, there would be a one-time EPS hit of 7 to 9% to growth. And this would not only be an increase in corporate tax, but also a doubling of taxes on foreign earned income, which will impact technology and healthcare. However, we do think that this is something that one can prepare for, especially if you avoid some of the huge concentration and crowding risks within the technology sector. Now, there is this belief that the Biden presidency will take on big tech. We think that the likelihood of this is relatively low in terms of success, even if they do attempt this. Antitrust and monopoly regulation is a very high bar to cross in the United States. And so we would expect there to be more cost increases for technology companies that must self-police themselves, especially some of the online media companies. But ultimately, we think that antitrust is a very hard case to prove. On drug price reform, we do think that we just need to look at businesses on a drug-by-drug basis. We generally do not take the view that investing based on scientific success is a very good idea anyway. And we generally feel that investing based more on the profitability of healthcare companies as an enterprise is a much more sensible way and a less volatile way of investing in healthcare overall. We do think that there are many ways of avoiding also this drug price issue, to invest in animal healthcare or in medical technology as well, both of which we think will be less impacted by a Biden presidency. We also do not expect universal healthcare to be rolled out, because that's exactly what Biden has said he would not do. It is also unaffordable. And while there is a public option that is likely to be introduced by a Biden presidency, we also think there are some benefits for some of the managed care organizations that have economies of scale and that will benefit from increasing the Medicare programs. So at this point, when we are not only ahead of a consequential US election, but also facing what seems to be a very clear upward trend in the global and US economy, there's often the question, should we stick with growth companies that have worked much better this year, or should we pivot to value, to cyclicals, to banks and energy? And many people have liked this idea because historically, this is something that has worked very well in past economic cycles. And also what usually happens is that the Fed raises rates when we are seeing an economic recovery, and that makes some of the growth companies a little less attractive than before. But the Fed has already said that it is not even thinking about raising rates. And so we do not expect rate increases until 2024. We do think that while it's likely we'll get a fiscal package in the US, that is not for certain. And without that, the seemingly inexorable rise upwards of the US and global economies could actually slow down or plateau, which is why we think one should be cautious when the key reason why we're in an economic crisis in the first place, which is this virus, has not yet been solved. We also do not believe in betting on particular outcomes in politics. And we think that ultimately investors should remember investing in equities is all about earnings growth. And the temporary effect, the sugar rush, if you will, of an economic recovery will give way in the long term to whether or not the businesses you own will be able to keep delivering earnings year after year. We also think that many people believe that a Biden presidency will be good for emerging markets and that Biden will be easier on China. We're not so sure of that, especially if he works effectively with multilateral organizations and historic US partners to speak to China not only on issues around trade, but also climate and human rights. We do not think that there is certainty on economic recovery, on a Biden win, or on a virus, and that's why we do not recommend investing in this way. And ultimately, in terms of positioning and valuation, we would recommend that investors stick to growth, although avoiding that concentration risk and looking for growth strategies that tilt towards healthcare. While there are select cyclicals that may do very well in an economic recovery, we think that the story for banks is somewhat limited by where interest rates are, and for energy because of the prospects of declining demand in absolute terms in future years. And that's really why at a time when growth companies are growing in tech and in healthcare, not only because of strong drivers to their business, but the fact that their businesses are taking share from traditional businesses, we would continue to invest in U.S. innovation. Thank you.